Youngberg, the senior analyst for energy, in particular oil and natural gas production exploration companies at Edward Jones in St. Louis, Missouri. So, Brian, I'm glad you're here and look forward to spending a little time with you visiting with our students about what you do and how you view the industry, and I appreciate you taking some time to do that. Can you spend just a minute telling us about yourself a little bit and what in the world does CFA mean?
Sure. Well, I'm originally from Nebraska and did end up getting my MBA from Washington University here in St. Louis. And at first I got into banking, a couple big banks here in the Midwest. And, you know, somewhere along the line there I started studying for the CFA. I really didn't know what I would do with it, to be honest with you, and just figured I really didn't want to stay in banking. And it's a 3-year exam minimum. It takes 3 levels. You can take 1 per year, and the pass rate is pretty low. I think it's half or less, so it does take a little bit of time, a lot of effort, and I was able to complete that, and I eventually took that and transitioned into assigning credit ratings to utility companies across North America, and did that for a short while and went through a merger there and survived that, but things were changing, and someone I knew at Edward Jones said they were looking for someone who knew the utility industry very well, and so we loved St. Louis when we were here before and thought that would be a good opportunity. And the only thing I really didn't know was how to value stocks because I really did not have to do that. And so came down to Jones in 2000 and worked on utilities, went through the Enron and post-Enron era, and then about 5 or 6 years ago I switched to energy, and just in time for the oil spill, among other things. So it's been an interesting 13 years here, but really enjoy it, and enjoy talking to not only clients but students and anyone interested in what we do.
Great. And tell me just a little bit about Edward Jones. I actually, driving around Farmington, see some what look like nice storefronts that say Edward Jones. What do you guys do? What is Edward Jones?
Well, Edward Jones is unique in that we are a full-service brokerage firm. We do not do anything really online or anything like that. And we are employee-owned. We are a partnership, which is very different also. But probably the biggest thing that differentiates us is that we are strictly focused on the individual investor. So basically the Wall Street to Main Street approach. And we have about 13,000 financial advisors across the U.S. and Canada. We are the largest non-Canadian firm in Canada. And what we do is we really just serve strictly the individual investor in really satisfying their investment needs, whether that is saving for retirement, saving for college education, that sort of thing. And because we serve individual investors only, you know, we have no conflicts of interest. We're not a big institutional type firm. We also don't do investment banking really, very, very little of that, and we don't offer options and all those kinds of things. So it's really for you know, individuals that need guidance and assistance in eventually reaching their goals, and really that's a good portion of the American public. That's really what we do, and we've not strayed from that all these years, and it's been very good for us.
It works well. I want to give a shout out to my friend Dennis Gross, who's the Edward Jones broker here in Farmington, New Mexico, for hooking me up with you. And I know Dennis is a good guy and does exactly like what you say. He sits down and works with individuals and helps them plan future. And you're giving him some insight on oil companies, because that's certainly something that is of interest to a lot of investors here in New Mexico. And that kind of brings us into our discussion here. As a security analyst, you're looking at oil and natural gas companies all the time. and our students have learned a little bit about some differences between technical analysis and charts and things like that, but we're really focused on fundamental analysis, which I know you are as well. And so how does a firm like Edward Jones start by looking at the whole market and then figuring out if oil companies make sense, and then how do you, from there, figure out what oil companies or gas companies make sense? Share us a little bit about the broad philosophy, would you?
Sure. Well, Edward Jones, we focus on diversification, quality, and the long term. And those are kind of the three-legged stool that we kind of focus on. Long term is harder to define nowadays with the recession and everything else. We think long term, but we also take into account the short term. And in general, we're going to tell clients to invest through the ups and downs because you cannot really predict when things are going to get better or worse. And if you have the opportunity when things are tough, that's usually a good time to buy in the long term. And same time, we also recommend at times for people to just be prudent in really good times. And sometimes it's not a bad idea to take a little profit and get a little more conservative with your portfolio. So that's kind of our big picture message. Combination of stocks, mutual funds, which is really our core business. Stocks are about 25% of our overall business here. That's actually up from a few years ago. And then we also have fixed income, obviously. And that's obviously has come back down here with the way interest rates have gone here more recently. So we have a big picture. We emphasize diversification. We have recommended weightings for different things. Within stocks. A certain percentage in healthcare, energy, financials, that sort of thing. We don't really deviate too much from the broad market, but we will a little bit. And from that standpoint, then when we get down to our stock recommendations, historically until a few years ago, we only followed the big integrated companies, Chevron, Exxon, and so forth, and that was really it. And obviously things have changed dramatically over the last 10 years or so, and so one thing I've been doing is broadening our coverage, and now we're up to about 20 U.S. companies under coverage across all different subsectors within energy. Now what we look for, there's some general criteria we look at. We prefer companies that have been around for a while as far as being publicly traded, typically 10 years. We might make a few exceptions there, but not too often. Investment grade credit quality, it kind of goes back to the quality investment idea. We like companies with good track records for investors. We'll make some exceptions there. If a company's maybe has suffered here lately, maybe underperformed their peers and so forth, we see an opportunity that they can actually improve. That might be an exception there. But in general, we want companies that think about their investors. And then we do have some market capitalization, some size requirements, typically around $3 billion or more. But with energy, most companies I'm picking up coverage on are much bigger than that. And then once we get into the sectors, we look for companies that have unique strategies or opportunities, and there's a lot of ways that can be done. Within energy, it could be location, where they operate. Are they in the shale plays? Are they in other hot areas? Their mix, profit margins. Where are their profit margins and where are they going? And then just their overall opportunities and that sort of thing. Eventually, we do look at valuation, a lot of metrics there, and then just some general things that we kind of really keep in mind. Like I mentioned, how Edward Jones is focused on the individual investor. One thing that's very important for analysts or portfolio fund managers in general is to know who your client is. And our client is Mr. and Mrs. Smith living on Main Street. And so in general, they're a little less risk tolerant than an institution like a big mutual fund company, that sort of thing. And that's why we take we're in general going to be a little more conservative than probably a lot of firms. A couple other things we tend to look at. I mentioned, we think long term, but at the same time we have to take into consideration the short term. And then the other thing we always try to keep in mind is, a good company does not always make a good stock. That's where the valuation comes into play. The greatest company, it may be just overpriced, and and same time a company that's struggling may be relatively cheap if we think they're going to improve. So that's kind of a broad picture there.
Let me drill down into that one for just a moment before we the last question on this slide. Students have learned about the concept of fair market value and market value. Is that really what you're kind of talking about right there in terms of something in your judgment being over or undervalued?
Yes. What we do not publish target prices. A lot of people will hear about a company, a brokerage firm has raised the target price on a company, from this to that and that sort of thing. We don't do that because target prices end up being kind of a random thing you keep chasing and you never really catch, and so we feel that kind of paints you into a corner. So what we do is we internally, we don't publish these, but we calculate what we refer to as an intrinsic value, which is what we think the shares should be. And there's a lot of things you look at there. You look at what their historical valuation measures are, what their peers are, where should they be relative to peers, discounted, premium, that sort of thing, and you make a judgment. One thing you have to do as an analyst is you have to analyze the stuff and make your recommendation. And so you take all those things into consideration. And we use a lot of different metrics. Obviously, PE is the one that most people out there have heard of. But you may look at price to book, price to cash flow, enterprise value to EBITDA is another common measure, basically a cash flow measure also. Within energy, you may look at price relative to proved reserves, things like that, discounted cash flows, things like that. There's a lot of different metrics. Yeah, you look at a lot of different things, and in some industries, some measures work better than others. Okay. I may use different measures than an analyst on our tech team, for example.
Well, I can imagine you would. I want to pop out of the slideshow for just 1 second and bring up the ConocoPhillips report to provide the students an opportunity to get an illustration taste of what you were just talking about here. I noticed here in your investment summary, Brian, that you're rating ConocoPhillips a hold. That's not really speaking necessarily to the quality of the company. That's really to the valuation idea.
Yeah, that's exactly right. ConocoPhillips is a great company. They've done very well. The spin-off of Phillips back in 2012 went very well, and I kept buying them both for quite a while. They both outperformed, and it basically got to the point earlier this year when I downgraded Conoco that I just didn't have as much upside on the shares relative to that intrinsic value as I did with some of their peers.
And so what I really want to have students understand and see if this is correct as I listen to you here, a judgment to downgrade a company from a buy to a hold may or may not be a reflection of fundamental changes in the company's strategy or quality of management team or assets. It could be just a function of the fact that the market's outrun where you think the fair market value should be. Is that kind of true?
Yeah, that's definitely true. Downgrades and upgrades can be caused by fundamental changes. Last week I upgraded Apache because they announced they're selling about a third of their Egyptian operations, which has been an overhang on the stock. Upgrades or downgrades can also be due to valuation. And Conoco is not having any issues with this. And actually a good example of this, too, is when I talked to the company afterwards, they fully understand where I was coming from on it. Right. And actually, since the downgrade, the stock has underperformed most of its peers. So we actually want our holds to go up. We just don't want them to go up as much as our buys, basically. That's the way to think about it. So we don't want them to go down.
If we looked inside the Edward Jones system, there's a lot of Mr. and Mrs. Smiths in Peoria, Illinois, or Manchester, Missouri, or Farmington, New Mexico that own ConocoPhillips.
Yeah, and we want those clients to retain their shares. If you own it, hang on to it. Pays a great dividend. It's a good company. But you know what? If you have new money to invest and you need to add some energy, hey, we have some other ones other stocks that have more upside right now.
Perfect. Last question on our discussion topic slides. Could you share just a moment about your views of a big integrated company versus one that's more of a pure play? You cover both. We certainly have both types of operations here in New Mexico. ConocoPhillips is a big player here in our world, as is Chevron, but so is Devon. How do you, as an analyst, kind of look at the integrated versus the more pure play or refiner?
Well, one thing to keep in mind is the suitability, as we call it, is different for most of these companies. The big integrateds pay great dividends, and they don't have much growth. If you're a Chevron or Exxon, it's really tough to grow, and Exxon's a great example of that. They haven't grown year over year now for about 3 or 4 years, and they're just such a big company, it's hard for them to really move the needle with new investments. So you really own the big integrateds for the income, and as a result, their suitability is what we call growth and income. And so you may get some growth over time, but you really own it probably more than anything else for their above-market dividend yield.
Okay.
And so the dividend is very important with the integrateds and so forth. Whereas the pure play E&Ps they tend to be growth. Some will be aggressive. There's only 2 growth and income E&P companies out there. One is ConocoPhillips, now that they've spun off Phillips 66. They're not an integrated company now. They're an E&P, and they pay a great dividend, but they have less growth potential than a company like a Devon or somebody like that. Then the other one is Occidental. And Occidental, same thing. They have a little bit less growth potential. They're also, not by coincidence, that they are the 2 biggest E&P companies out there. The bigger you get, the harder it is to grow.
Yep.
And so forth. So you look at that. So you want to, we want investors typically to have some growth in income, some growth, some aggressive. Take a look at that. And really, the way I look at it is, I look at the stocks within each subsector. So I compare the integrateds with the integrateds. They're going to have different valuation measures. They'll have lower price to earnings ratios, for example, than a growth-oriented company.
Okay.
Things like that. And so
you are comparing an apple to an apple, then, really.
Exactly. So you want to look at the oil service companies together, the refiners together, the E&Ps, and then within those, you then look at, okay, which ones do you think have the best growth opportunities, manage the risk best, and then eventually which ones have the most upside. And nowadays it's been kind of different, that you have to take in things like, for example, Apache with their big Egyptian operations. Well, I downgraded that earlier this year, and I even said right then, this stock has the most upside of any of the E&Ps I have. But at the same time, Egypt is in the headlines every day.
Right.
And as a result of that, I just think between that and the fact that they just lowered their guidance for this year as far as production growth, that this stock is just going to do nothing until things get a little bit better. And so I downgraded, and sure enough, it really did nothing. Well, a lot of the E&Ps went up here the last few months, and because basically investors said, I'm not going to touch it until Egypt calms down.
Yep.
And so it's a good example of, even though there's upside on paper, the stock should be trading higher. The reality is the market doesn't have an interest in it for the time being.
Gotcha. All right. Moving on to the next slide here, I'd like to do a quick tour of a couple of your research reports. Brian, just to kind of share with the students how a research report is put together and how to think about and use them. I realize that not all companies have exactly the same sort of layout and all with research, but there's a lot of similarities, and this would be a golden opportunity for them to hear from an author of research. I'm going to pump the zoom up here just a little bit. I noticed that one of the reports that you produce on a regular basis is something called the Energy Sector Report. How does this report get used, and what do you do with it?
Yeah, these energy sector reports, what they are they can be general pieces in the sense that, like I have an updated quarterly, well, we update all these reports quarterly, we're required to do that, but like I have one that says like a second quarter energy outlook, third quarter energy outlook, that sort of thing. It's kind of more general, kind of where we see prices going and things like that. And, that's kind of an educational piece. just to kind of tell people what's going on and what we think is going to happen. And then we also have what we kind of refer to as hot topic reports. Some of those would be like the America's Oil Rush report, kind of talking about the oil shale production. It's in the news all the time. Liquefied natural gas shale a few years ago when that was kind of new and so forth.
Okay.
So things like that. We kind of think about what are people talking about when it comes to energy. High gasoline prices. So we'll write some of those. Most of the hot topic reports, we will write those. I like to write them as kind of a FAQ type look to them. So you'll notice I have questions, and then I just answer that question. We put some charts in there. People like charts as long as they're not overcomplicated. We always try to think, is this simple enough for the average person to understand? Because a lot of people don't look at charts like this too much. So we do try to keep it pretty simple and straightforward as we write these. The other thing I would know is we tend to write these in a simple language without using industry jargon, things like that. I'm not going to say crack spreads, which are refining a refining term. I'll say refining profit margins. Yeah. It says it's the same thing, but people can understand the second one. They won't understand what a crack spread is. Right. And so that goes back to knowing your client and so forth. The other thing we tend to do in these is we also, at the same time, we're telling people, okay, here's maybe 4 or 5 questions that we think most people want to know an answer to. We also will give them guidance. We will mention about a half a dozen or so companies that we think you may want to look at if you have an interest in investing around this idea. Okay. And so that's kind of what we do. And every quarter we go through these and update them, and sometimes we rewrite them altogether or just move things around, and some don't get updated much at all. Okay. It kind of depends.
And then from there you actually go to creating research reports on specific companies. And I've got a number of students interested in a company you're following quite closely and have actually recently upgraded. And so our students have access to the library of reports that you have, and I'm not going to take you through all of them. We looked briefly at the ConocoPhillips hold. But I'd like for us to look at this one report in a little more detail, Brian, and then we've got some student questions that have been asked about Devon that I'd like to look at specifically. So this is a report. When did you start covering Devon? Was that relatively recently?
It was recently. This was the most recent company I initiated coverage on. I went and visited the company in December of last year, and then I initiated coverage in April. And usually there's not quite as much of a time lag between those two, but I had some other things I was taking care of in the meantime. And so I initiated coverage with the hold. It's a company that has underperformed historically. They've gone through a lot of changes the last few years, kind of lowered the risk profile of the company, but at the same time they're still very weighted toward natural gas and natural gas liquids and oil coming out of Western Canada, and all of those products are sold at a discount right now. So I initially came out with a hold on it with the idea that I had some decent upside here, but I think there's going to be some headwinds here that may cause it to underperform a little bit for a while.
So before we get further into the report, I want to make sure I understood this. You actually went from, or flew from Lambert over to Will Rogers Airport there in Oklahoma City and sat down with management, and what did they do in that? I've heard about security analysts coming and visiting. Is that, it was like a field trip, or what happened?
Well, typically, before all this, you know the industry, you know who you don't follow, and you're looking at, okay, which ones maybe make sense. There is some selection bias. You're logically are going to probably pick up companies that you think you can get to a buy right away, or at least in the short term. Devon was one of those I've looked at off and on for quite a while, and I thought it was a good time to do it. And so basically contact them and went down and spend a couple hours with them. In most cases, it's with the investor relations staff. I generally will ask if I can talk to someone higher up, even the chief operating officer. I've even met with CEOs before, but big energy companies it's a little harder because they have so many, institutions to deal with. It's hard to get in there with them. But at the same time, and basically just go through. I prepare ahead of time. Kind of a list of topics I want to make sure I discuss and that sort of thing, and just kind of go through different materials and just talk to them about it. And
so it's like kicking the tires, so to speak.
It is like kicking the tires, and it's a little hard to go out and see operations because these companies are generally operating out far away from their corporate headquarters anyway. But there's times when you might get out to go see something, that sort of thing. But yeah, and that's something we try to do at least on an ongoing basis. In the last year, I've seen I think about 12 of the 19 companies I follow. And if I haven't seen somebody in a year or so, I'll probably look to go see them. About half my companies are based in Houston right now, so I go to Houston 2 or 3 times a year and just try to see 3 or 4 at a time over a couple days, basically, and make the rounds essentially.
All right. And so, as the research report goes, you have a little box here that has some highlights. It looks like, and I see something down here that caught my eye called recommended sector weight. What does that mean?
Well, we recommend a diversified portfolio be no more than 12% in energy. And what's interesting is that's going to be somewhat close to the S&P 500 weighting for energy. We don't deviate a lot from that, okay. But at the same time, right now, if you look at what we call our stock focus list, which is kind of a portfolio that we use to it's been used in the past in Barron's and Forbes and so forth, to kind of compare us with other firms. We are actually a little bit overweight that. So we actually are, I think we're about 14 or 15% energy, because energy's lagged the last year or two, and we think it's a good time to be beefing that up a little bit. And so, and at the same time, I'll go down to Houston, and our average client down there is about 50% energy. So. Yep. And then I'll go to Seattle, and they're overweight tech, and they might be 3% energy. So we want to provide guidance on what to kind of target. We know people are going to be above and below that, and that's fine. But at least move in that direction if you can over time, and so it's another just part of our overall general guidance.
So that'll help the broker in discussion with the individual investor too.
Right. They can actually pull up on their screens and see where they're overweight, underweight, all that kind of stuff, and make recommendations.
All right. Now, when you picked up coverage on Devon, you start off with them as a hold, which was a little unusual, but you liked the company. You say here they're moving in the right direction operationally, and you believe upside catalysts are becoming clearer. And I don't think that's quite like cracking margins, but I still sense some jargon there that relates to upside catalysts. Kind of run that sentence by me, because that's the justification for what you're doing there.
Yeah, basically operationally, and you can see this on page 2 of the report a little bit in the recent news. They've reported both first quarter and second quarter earnings since I initiated coverage with the hold. And if you go down to August 7th there, a couple paragraphs down in recent news, they basically have reported production figures a little bit above not only their guidance but market expectations, and also their realized prices that they're getting. And basically you compare their realized price, what they're really getting for their oil or natural gas, you compare that to in a percentage basis relative to West Texas Intermediate or Brent crude or Henry Hub natural gas, and it's going to be some percentage. You look at that relative to history and that sort of thing. You kind of extrapolate that out into the future. But basically, they realized more per barrel than I thought and what most others thought. And so operationally, they seem to be delivering on what they said they're going to do, and they're actually exceeding that a little bit.
Our class has learned a little bit about hedges. Do you think hedges might be playing a role in how they're able to beat the market price?
Well, hedges can. Most companies will disclose what their hedges are. Sometimes it can be the locational differences with oil and natural gas are very hard for people that aren't out in the field to really get a gauge on, because you have all these transportation levels that kind of come into play, how far away the oil is from where it needs to be, that sort of thing. And so there's some things like that come into play. And then, sometimes, these percentages just kind of go up and down every quarter, and you kind of make reasonable assumptions. And the percentage natural gas liquid prices relative to oil have come way down because we have a glut of NGLs out there, and oil prices have gone up. So you kind of assume, okay, they're going to go back up a little bit. They're going up this quarter, next quarter, that sort of thing, and you make assumptions and go with it. And sometimes you're right on it. Sometimes you're above or below, that sort of thing. The other thing, as far as just their the headwinds, and I agree, it's always a little hard to talk about catalysts and so forth. But something that will jumpstart the shares. And lately they've been doing pretty well. This week they're up 2 or 3% since I made the change. Not that I'm going to take credit for that, but the catalysts are becoming clear. Production growth is better so far this year. Like I said, 2014 production growth should really accelerate from roughly 0 to about 5 or 6%. And so that kind of gives me more confidence that they're going to deliver on that. And
so
then
these are really like these catalysts you're talking about. These are the drivers of share price then.
Right. Essentially, yeah.
Okay.
What catalyst will drive the share price? And so and the market is always looking forward. It's not necessarily what you just did. It's really what they think you're going to do in the future. And so as your confidence in what they're going to do in the future improves, that should help the share price. The other thing I would just know is the commodity prices turn out a little bit better. We do see natural gas prices gradually moving up in the future. We think NGLs, if they haven't bottomed, they will shortly. And then Western Canadian crude, which has been discounted, with all the rail cars coming out of Western Canada, eventually maybe Keystone XL and some of the other pipelines, we think that discount is going to go away. And the market is always ahead of the actual results.
Okay.
And so we want to be, I always say, I'd rather be a little bit early than late.
And
like
these bullets that you see, right? Yeah, absolutely, because otherwise you miss the opportunity to get the appreciation.
Right.
But looking here at bullet points, these are your catalysts then: pricing discounts, production growth, onshore focus. So this is really kind of what you're talking about.
Yeah, they're catalysts. They're kind of the. We always tell people, if the financial advisor is going to talk to the client, here's 4 bullets in a sense that you can talk to them about.
Okay.
Why do we like Devon? We think their pricing discounts are going to ease, production growth is going to improve. We like their risk profile now that they've exited the offshore.
Yep.
And they're going to have a master limited partnership.
Yeah, in fact, I want to
creating
talk
and
just
so forth.
I want to visit with you just a bit about that, because I see you actually wrote that up in detail down here, and we're going to get to a couple student questions and touch on that. So generally, as we've talked in class, Brian, we've talked about the different risk profiles, and Devon has some midstream operations. Our students have learned what those are, and one of our students learned about the fact that she works for a utility, as you would classify it anyway, with Williams. What is underlying Devon's reason or rationale to basically take a piece of itself and spin it off or sell it to its, or give it, I guess, actually to its shareholders so they can do with it whatever they want to? What's underneath that?
Yeah, well, one thing I will note, the MLP, Devon will still manage it and still own a big chunk of it. So, they basically get some cash out of it, but they kind of still retain ownership. But at the same time, the reason companies create MLPs, and we've seen a lot of them done recently, is basically the idea is that a pipeline, especially anything that has a more steady cash flow, which pipelines are perfect for, they can then use that to help eventually pay the dividends that or the outflows, the MLPs do pay out. They're not dividends, but the outflows to their investors. But the MLP structure is inherently a cheaper cost of capital than a corporate type structure. And so that's why a lot of these pipeline companies, production companies, Conoco has 2 or 3 MLPs, Phillips 66 has one. I mean, a lot of these companies have done one.
A big one here in our neck of the woods is a company called Enterprise.
Enterprise, Kinder Morgan's a well-known one. They're the biggest and so forth. And the idea is basically it allows you to, you can basically bid on projects and do projects cheaper. Because of the MLP tax structure and so forth, allows you to have a lower cost of capital.
So in this case, it's not Devon necessarily getting rid of the business because of a risk mismatch between E&P and pipeline. It's they actually like the pipeline business for the reasons you've mentioned. But isn't it true in some cases people spin off like refining business because there is a fundamental difference between the two types of businesses and the market looks at them differently?
Exactly, and that was really the origin of the ConocoPhillips Phillips 66 spinoff is, unless you're a big company like an Exxon or Royal Dutch Shell, somebody like that, being an integrated company nowadays probably doesn't really create that much value. And even if you look at some of those companies, Royal Dutch Shell has sold off half of their refining capacity over the last decade, kind of quietly, piece by piece. But if you're a kind of more, I guess you want to call it a mid-sized company like a ConocoPhillips, they're never going to be the size of Chevron or Exxon. Does it really make sense to be an integrated company which gets lower valuations? They have lower PE ratios and so forth. Or you can split it up and allow investors say, I want the commodity exposure and that the ConocoPhillips brings. That if oil goes up, Conoco will go up. But at the same time, other investors will want to own Phillips 66 for the growth in chemicals and their midstream business and all that kind of stuff. So, because otherwise the investors may say, I like the dividend and the pipeline business of the old ConocoPhillips, but you know what, I don't like the commodity price exposure, or I don't like this, and so it allows investors to pick and choose what makes more sense to them.
So the board of directors has basically empowered investors to get what they want, sounds like.
Exactly, and these things kind of come and go. There was a time when I dealt with utilities back in the 90s. The move was you got to get bigger. You got to be electric gas. You got to be trading like Enron. You got to be doing all these different things. Otherwise, you're going to be run over. And now the message is be focused, do one thing, and do it real well. And
yeah.
so
you and I go back far enough to the Enron days where, like you, I was doing the same thing with institutional investors I was serving. They're so big and so complex, I don't know how the hell they'll do it. In fact, I'm not sure they are doing it, but I don't know. Yeah, we've all been there. Well, that's been great to kind of see a tour. The guys have a copy of this. You've got some discussion on dividends. You've got some research disclosures that you've reviewed this and that you're not being paid personally out of that. That's all kind of new out of that. Looks like you've got some lawyers at Edward Jones.
Yeah, fortunately that's all boilerplate. We don't have to write any of that. It kind of spits that stuff out. But yeah, if you look at we have the investment summary on the front page. We have recent news, kind of an industry outlook, company outlook, kind of quick summaries, and then we may do kind of a financial position overview, and then we do talk about the dividends because being that we serve individual investors, the dividends are extremely important.
Yeah, absolutely.
And,
Mr. Smith like that.
Yeah, and we typically, we definitely prefer companies that can raise the dividend, over ones that do not. No question about it.
Well, and that brings us to a couple questions that our students asked. A couple of them are exactly about Devon. A couple of them are generic. This first one here is, when you're looking at companies, and I think hinted at this a little bit with the Apache story, how do you consider geopolitical concerns, all things being equal?
Well, being focused in the U.S. right now is a positive,
Okay.
and no question about it. And, and that's why you're seeing a lot of these more domestic companies. I think are benefiting from that in terms of valuation, and the companies that are focused there on growth. ConocoPhillips, their growth is coming from U.S. oil. Devon, I think, got out of the international stuff at the right time. And Apache and Occidental and Hess, really those three companies are the ones that I follow that have gotten a lot of flack over where they operate. And the problem Apache has, I'll just use them as a good example, is Egypt, they've been there for decades. They get about 20%, or in the past they've gotten about 20% of their production, and about 30% of their earnings out of Egypt. It's their most profitable country. And same time, they've had no problems since all the turmoil over there. These operations are out in the desert. It's used domestically to, keep the lights on in the country. But at the same time, people just don't want to deal with it. And so investors have just avoided it. And so Apache, I've said for a while, Apache isn't going to sell the whole thing, but I think it probably makes sense for them to reduce their exposure there, and so they actually brought in a partner for 1/3 of it. It's one of the China oil companies, and they still will operate it, but it really reduces their risk profile. Plus, it also shows what the value of that entity is, because the company's paying over $3 billion for it, so that kind of equates to about a $9 or $10 billion value to Egypt. And I think a lot of people have basically said, Egypt's probably essentially not worth anything, and the stock popped pretty good last Friday on that announcement. But Occidental's kind of in the same boat. They operate in Yemen and some of these other countries over there, and some of those are very small for them. But I think at the end of the day, I think investors would like them to sell some of their other businesses like trading and so forth, also maybe get a partner for some of their Middle Eastern operations and focus back in the U.S. because Occidental, a lot of people forget, Occidental is the biggest onshore oil producer in the U.S. They're the biggest in the Permian, they're the biggest in California, but people are so hung up on the Middle East exposure and a couple of.
You there? Brian, you there?
Are you there?
Yeah, I'm here. Are you there? Can you hear me?
Okay. Can you hear me again?
Yeah, I can hear you. So
yes.
Yeah, so they're focused.
Okay. Sorry about that.
It's almost like, Brian, what you're telling me is a 3% exposure to Yemen overshadows the realities of 97% in North America.
Well, that's a simple way to think about it. Yeah, and it's so right now, the challenge is that how long will that last? Will it end ever? If it goes away, that may prove to be a great opportunity.
Okay.
So.
I see another question we've got highlighted here that applies to Devon, but it's really a big global question as well. A company has cash available to use for dividends or to reinvest in itself, and the student here asks about, well, what about investing in stimulating older wells, given oil prices being up? Is it a good thing for a company to spend money on dividends or to reinvest in itself or to buy up its shares? How do you, as an oil company analyst, look at that question and think about it?
Well, I prefer the cash. There's a lot of things they can do with the cash, obviously. The things I prefer they not do or be last in line is generally make acquisitions and buy back shares. We tend to take an approach that we would prefer the companies to give the cash back to the investor and let them decide how to invest it. And the best way to do that is through paying a great dividend. And ExxonMobil is a great example of that. I actually criticize Exxon in my research report, and others do the same thing because they're so focused on share buybacks. And I just wish they would just increase the dividend and reduce the buybacks and let the owners of the shares decide if they want to invest it back in Exxon shares or invest it in something else. And the other thing, companies have to invest back in their business. The trick is to not overinvest in your business. because you can also just kind of start throwing money left and right. You know, and then if you start running into a negative free cash flow, which basically means you're spending above your operating cash flow, and then you start either issuing equity or debt to fund that, you might be able to do that for a year or two, for a little bit. You know, if you're really showing the growth and you're really getting good results. If you're not, the market is going to really kill you.
Yeah, you better be, as we've talked in class, you better be stuffing a lot of cherries in that pie if you're going to add more slices to it.
Yeah, exactly. And so, you know, I look for a balance of, dividends, appropriate capital spending back in the business, and you know, and if there's cash left over, then you go ahead and maybe buy back some shares, you know, make some small acquisitions, things like that. But most acquisitions in the energy world lately have not gone well. So,
well, and just, yeah, I'm thinking here in New Mexico, at one point in time, shortly after Conoco bought Burlington, 12% of Conoco's global assets were headquartered in this one county. But it wasn't more than a couple years later that there was, on a $35 billion acquisition, an 8 or 10 or $12 billion write-off. I can't remember how big it was.
Right.
It was big.
Yeah, you know, and you know, that's a great example of ConocoPhillips not knowing who they were. And I wasn't really following Conoco at the time, but you look back, you know, Conoco was trying to be the next Chevron. You know, they're half the size of Chevron, or probably less than that even really at the time, but they're trying to become a Chevron, Exxon type company. And it's like, you know, that's not what you guys are. And so they went out and overpaid for Burlington and other properties and took big write-offs, and eventually they finally got what people were telling them to do, is be a smaller, more nimble company and be ConocoPhillips. Don't try to be Chevron.
Oh, gotcha.
And they finally heard that, and lo and behold, the shares started responding well.
Yeah, exactly. Funny how that works. Our last question for the students, Brian, deals with ConocoPhillips. You may or may not know anything specifically about this, but we've got a potential oil-rich shale play here in the San Juan Basin that is called the Mancos Shale. ConocoPhillips owns a lot of lease acreage here. They're the big 800-pound gorilla in our market, and there are certainly some companies, as the student submits, that are working on developing and discovering and figuring out how this particular play may work. And yet ConocoPhillips is not seemingly doing anything. And the student asks, well, I would think that Conoco would want a lot of that. You may not be in a position to speak exactly to Conoco's thinking on this, just in terms of materiality and all the companies you follow, but can you share with us just a little bit about what you would expect the management of a company to be doing as it looks at how to allocate capital? Does it go to where it believes there's easier money or harder money, or what would you expect?
Well, you really want the companies to invest where they can get the best returns based on the general outlook for oil or natural gas in the case of these companies. And right now natural gas prices are relatively low. The returns are much greater with oil. And so companies like Conoco are really focusing all their capital on growing their current shale positions in other plays.
Okay.
Whether it's Eagle Ford, the Bakken, and so forth. And so that's really where they're focused, rather than doing exploratory type drilling, kind of seeing what's there. So if Conoco has acreage here in this oil shale play, my guess is they're probably going to sit on it for a little while. You also don't necessarily want to be the first guy out there drilling.
Yeah, so companies like WPX or Encana, which I think you would argue are more risk averse, or I'm sorry, not risk averse, more risk tolerant. They're more likely to take some risks. Those are the companies we're seeing drilling here, not Conoco, but Conoco may be sitting back and waiting and watching what happens. Is that fair? Yeah,
I think so. And if you're thinking 2 or 3 years out, let's say, and Conoco is also a node. They run pretty tight cash flow right now. They're not covering their dividend, their capital spending. They're actually selling assets and that sort of thing to help fund this for the next couple of years. I think once they get past that, if the other production's going well, and maybe in Canada WPX has some success in the area, then that's when I think Conoco would probably start, going, okay, we're going to start drilling some initial wells here and see where it goes.
Okay, good.
Yeah.
Let me wrap up our interview tonight with this last question here. We've got our questions and answers from students, and this is one that the students didn't ask, but I wanted to ask you because I know firsthand, having worked the investor relations side of several companies you and I talked about ahead of time, what an interesting world either investor relations or the security analyst has. I mean, they're two different sides of the coin, but they're very much the same. I did decades of financial modeling, just like you do financial modeling, and a lot of our work would be comparing our respective models and assumptions. If you were interested as a student looking at the world of investment analysis, so portfolio management, sell-side security analyst, give us some advice on what a student should be doing and thinking about and pursuing a career like that. My students are mostly in smaller towns in New Mexico. They don't live in big cities and all, but that doesn't mean they don't have good minds and they aren't learning a lot.
Yeah, there's a lot of things you want to take into consideration. I think first and foremost, I always tell people, if you really have an interest in doing something, at least in this general area, definitely look at the CFA and dig into that. Like I said, it's 3 tests. It takes, really it takes at least 2 years to finish because you can take level 1 twice a year. They give it 2 options, and then you can do 2 and 3 is only offered once a year. But kind of check into that. It's a big commitment, but I did it kind of going in. I got into this a little bit different. Most of the people we have here, we hire out of college, and they're they have MBAs or some undergrads. It's kind of a variety of people, and they start working on the CFA and they crank it out really quick. And I did it when I didn't even know what I'd do with it. So
right.
So I kind of came in a little different angle. But the CFA is definitely something to take a look
Okay.
at. Just the other things, kind of the skills you need. I always tell people, obviously analytical type skills. If you find yourself analyzing everything to death like I do, I analyze everything, sporting events, movies, whatever. I analyze everything. I have to tell myself to turn my brain off sometimes. That's obviously a big piece of it. But the other things I always tell people, communication skills are very important. Not only internally, but I go out and do client events. Next week I'll be in Wyoming doing client events out there. We go on TV for different interviews, things like that. So we get training for that, but you have to be able to do that and do it comfortably. And when I first got here, I was thinking, oh my gosh, I got to do TV and stuff, and within a year or two I was on CNBC talking about Enron. So you just learn and do it, and you just I think more people are better at it than they give themselves credit for.
So really a whole big set of skills, it sounds like.
Yeah, being proactive, self-starter, all those normal things. We tend to be alpha personalities for the most part.
Yeah.
But we worked well as a team, and then just general things we do. We read a lot. Always trying to keep up on the industry, what's going on, and react to things when you need to. But at the same time, you also want to be proactive and be like I upgraded Apache the other day, kind of in a reactive mode to their announcement, but I upgraded Devon the same day, being proactive.
Okay.
So you kind of use it. And you're always kind of thinking, what am I going to do? What should I be thinking about right now?
So a book like Daniel Yergin's The Prize would be something you'd like to read, probably, right?
Sure.
Yeah.
Sure. Yep.
And you read regular business magazines like
Well, I read probably mostly. I read a lot of industry stuff.
Okay. Like Gas Journal.
Yeah, some of the different journals. just I'm always looking on the EIA website to kind of keep up, just in general.
Hold on a second. Is that the Energy Information Administration website where our
Yes.
students are getting pricing database homework from?
Exactly. We get. You'd be surprised how many people cite EIA and their charts and everything else. And just kind of reading the internet. I mean, I always have to. One thing I simply do. Sometimes I can just Google oil or Google whatever in Google News and see what's going on. I'll Google companies I don't follow, just stuff like that, and just try to keep up on all that stuff.
So kind of almost a foundational DNA sense of curiosity, I would imagine. Then.
Yeah, I think so.
Okay.
Just one challenge I kind of have is that if you look at most people that do what I do, many of them are in Houston, where all the companies are. Many are in New York. Many of them in the energy world have energy backgrounds. They work for energy companies. Some are petroleum engineers by trade, and so they kind of know the industry and some of the ins and outs that I don't even know. So one thing I try to do is that kind of makes me want to try to read and learn and keep up even more, and ask a lot of questions when I'm out talking to companies. And
so that's where you pick up on things like the cracking margin, or what was that word you were using?
Crack. Well, you have crack spreads, and then crack spreads, and
all right, cool.
Different things like that. And
the last thing I've got related to this question, Brian, I bet I know the answer, but I'd like to kind of hear it from you. How important is it for a student who wants to do your line of work to really understand finance and Microsoft Excel?
Well, very important, obviously. The CFA is a good example. We actually require the CFA, in our shop, and I know other firms do too. And but most everyone here just has an inherent interest in doing that. My undergrad was in finance, my MBA was in finance, that sort of thing. So it's definitely important. What was the second part? I'm sorry.
The tool Microsoft Excel.
Oh, Excel, of course.
Yeah.
Well, it's funny you mentioned that, because yesterday I was taking an advanced Excel class on Excel, the current version of Excel 2010, I guess it is, and learning how to use different functions and things like that, pivot tables and all these other things that I don't know if I'll ever use, but I was learning these things, and you realize the amount of things you can do with Excel is unbelievable.
Yeah.
And the guy that taught the class is someone I've known for years and years, and he even says I probably know half of what Excel can do.
Yeah.
So get on there, mess around, and just kind of
you actually have financial models that you built with that tool, I'm sure.
Yeah, what we do is we keep models for every company with multi-year projections built in, and they're linked to our commodity price spreadsheet. So we have commodity price projections. We link those. And then we generally have historical data. I got some models that go back before 2000 even. That's probably the oldest. But and then others you don't do, as far like when I built Devon's, for example. I only went back to 2010 because before that it was a totally different company.
Yeah.
So I felt like before then it probably didn't have that much value anyway. So why bother? Because you do basically have to build it in a sense manually. We probably don't do as good of a job as we could linking it to Edgar and some of the other data sources where you can just download it a little more automatically. That's something we're kind of in the midst of trying to get better at.
Bottom line, though, is you better like numbers. You better like numbers.
Better like numbers. People kid me because I do ratios in my head. Percentage. I'll go, oh, that's about probably like 17%. I'm usually pretty darn close. I'm usually within 1%. And I just do those things in my head. I struggle remembering names of people I just met, but I can do numbers spontaneously. So it is kind of funny.
Brian, this has been a great time. I really appreciate you providing a service to the undergraduate and graduate students of New Mexico Highlands University Finance 425, 525. they'll be watching this recording. I'd love to be able to visit with you again next year about things, and maybe even before that. So appreciate the fact that you're taking time away from family on a, I guess it's Thursday afternoon. It's time to get home for dinner, time to move on. But it's been wonderful, and I thank you for the insights. I've learned a ton, and the students will also. So appreciate it. I want you to have a great evening, okay?
All right, thank you, and appreciate the opportunity, and just wish everyone good luck with school and their work and everything else.